Welcome to the Financial Market Examiner YouTube channel, where you learn about Forex, crypto, and the stock market. On this channel today, we'll learn about margin in the stocks market. What is margin? The simple definition of margin is investing with money borrowed from your broker. There are two primary types of brokerage accounts. In a cash account, you invest your own money. In a margin account, you can borrow from the brokerage based on how much you've invested. When you invest in margin accounts, you are able to purchase stocks according to your buying power, which includes both your own cash and a loan against the money you have invested. What is margin trading? Buying stocks on margin is essentially borrowing money from your broker to buy securities. It leverages your potential returns both for the good and the bad, and it's important for investors to understand the implications and potential consequences of using margin. First, using margin means paying interest to your broker for the money you're borrowing. As Fidelity, for example, the interest rate you pay on margin balances up to $24,999 is 8.325%. When you compare that rate to the 9% to 10% potential annual return in stocks, you quickly recognize that you're taking the risk. But the broker is getting much of the rewards because of interest. When you use the margin, you have to worry about your net profit margin or your profit after paying interest, which will be less than your investing gains. Investors should also be aware that broker firms have initial margin requirements or minimum margin requirements, requiring the investors to put a minimum amount in the account before they can borrow from the broker. As Fidelity, you must put in $2,000 to use margin. In order to buy an individual stock, the margin requirement is 50%, meaning if you want to buy a $10,000 of a stock, you have to put in $5,000 in equity. There are also maintenance margin requirements of at least 25% equity, which would apply when account values falls, and that rate may be adjusted depending on how the account performs and broader market volatility. Let's give you some buying on margin example. Assume you have a $1,000 in cash and want to buy $2,000 worth of a stock that trades at $10 a share. You can put up to $1,000 of your own money, borrow $1,000 from your broker, buy 200 shares, and you'd own $2,000 worth of that stock. Your net account balance will still look like you have $1,000, but it will show up at $2,000 in stock, and a $1,000 margin loan from your broker went up from $10 to $12. That's a 20% increase above your purchase price. And at that point, your 200 shares would be worth $2,400, and your account balance will reflect a total of $1,400. That's $2,400 in stock minus the $1,000 margin loan. That's a 40% increase to your account value on only a 20% increase in the stock price. Of course, the margin cuts both ways. Say that the stock instead dropped 20% from $10 to $8, and at that point, your 200 shares would be worth $1,600, and your account balance will reflect a total value of $600. That's a 40% increase to your account value on only a 20% decrease in the stock market. There is a bigger risk in margin trading than simply losing money than you otherwise would have. What is a margin call? When you have a margin loan outstanding, your broker may issue something known as a margin call, particularly if the market moves against you. When you get a margin call, your broker can demand you pony up more cash or sell out positions you currently own in order to satisfy the call. If you can cover the call, your broker will liquidate your position to get it covered. If your broker starts selling out your position, that broker doesn't care about your tax situation, your view of the company's long-term prospects, or anything else other than satisfying the call. If the market really moves against you, say the company whose stock you brought on margin declare bankruptcy and the stock become worth $0, you're still on the hook for your borrowed funds. Why buying on margin is a bad idea? Short-term movements in the market are almost impossible to predict, and there's also the risk of a black swan event like the coronavirus pandemic crashing the market. While the upside of margin trading may seem appealing, the downside risk is much greater. As an investor, you have no control over the timing of a margin call, and you can fall victim to one even if it's just a short-term movement, even if you still believe that a stock will recover, and it does, you could still be forced to liquidate, meaning you missed out on gains you would have gotten if you were using an ordinary cash account. The interest payments and maintenance requirements add other costs and risks, especially for beginners investors. It's best to avoid trading on margin since it's not always clear how much you've borrowed from your brokerage and how much you have in equity. Plus, it's easy to think of all your holdings as your money even if much of it is borrowed. Remember that it's beneficial for your broker for you to use a margin accountant is an easy way for them to make money, so it's in their interest to encourage you to do so. The recent events with Wall Street best stocks like GameStop offer the best argument for not using margins. It's easy to get sucked into such trades when the stock is skyrocketing. But GameStop just as quickly reversed, leaving thousands of traders facing a dreaded margin call. With this, we've come to the end of the video for today. Kindly share with us your feedback in the comment section, and there's several educative videos on this channel for you to learn more about the financial markets. Note that this video is not for financial advice, but for educational purposes only. Kindly subscribe, share, and like after watching. Thank you.